Hey everyone, and welcome back to the channel. If you have been keeping an eye on the markets lately, you have probably noticed something a little unusual and maybe even a bit confusing, and which is crude oil prices are falling sharply. But at the same time, the US dollar index is also sliding, and that is something we don't usually see together. Now, for those of you who follow macroeconomics or trade commodities, you will know that crude oil and the dollar typically have an inverse relationship. By that I mean, when the dollar goes down, crude usually goes up, and when the dollar goes up, crude usually goes down. But right now, something crazy is happening, and that is both are declining at the same time. And this isn't just a short term blip, it's a break from one of the most well known correlations in global markets. So, today we are going to dig into this unusual market behavior and break it down into three key parts. First one, we will look at the historical relationship between crude oil and the US dollar and why it matters. Second, we will dive into what's happening right now in 2025 with real data and market context. And third, most importantly, we will explore what this means for you, whether you are a trader, long term investor, or someone just trying to understand the bigger picture. We will talk about how central banks, OPEC, inflation, and slowing economies are all playing a part in this macro puzzle. And by the end of this video, you will not only understand what's going on, but also have actionable insights to help you navigate this phase of the market. So, grab your coffee, stay with me till the end, because this is not just another chart breakdown. This is about understanding the deeper forces shaping the markets in 2025 and beyond. All right, let's start with some fundamentals. Historically, crude oil and the US dollar index have shared a strong inverse relationship. And here is why that makes logical and economic sense. And the reason behind is that crude oil is traded globally, but priced in US dollars. So, whether you are buying oil in India, Europe, or Japan, you are paying in dollars. That means the relative strength of the dollar directly affects how expensive oil is for the rest of the world. Now, let's break it down further. So, when the dollar index goes up, and that means the US dollar is strengthening against other major currencies like the euro, yen, or pound. And as the dollar becomes stronger, oil becomes more expensive for the countries using weaker currencies. So, what happens? Demand drops because buying oil suddenly costs more, and that tends to push oil prices down. And on the flip side, when the dollar index falls, the US dollar weakens. And now oil becomes cheaper for countries using other currencies, and the global demand often picks up, especially from emerging markets, and that leads to higher oil prices. So, if I have to put in simple terms, dollar goes up, oil prices go down. And if dollar goes down, oil prices will go up. This inverse correlation is especially visible during stable macroeconomic periods, when inflation is under control, global growth is steady, and monetary policy is predictable. In fact, if you look at data from 2014 to 2016 or 2020 post COVID stimulus, you will see clear instances where a falling dollar directly corresponded with rising crude oil prices, and vice versa. But remember, this relationship isn't a fixed law, it's a macro tendency, and it can be broken under certain conditions. like we are seeing right now. Now, let's bring in real world historical example to understand this inverse relationship between crude oil and the dollar index and how macroeconomic forces play a major role. During the second half of 2018, crude oil prices plunged dramatically, falling from around $75 per barrel in October to just $45 by December. That's a massive 40% crash in just 2 months. At the same time, the dollar index was rising steadily and hit some of its highest levels of the year. So, what was going on? Here is what drove that movement. Fed rate hikes. The US Federal Reserve had raised interest rates multiple times in 2018, in fact, 4 times that year alone. Higher interest rates in the US made the dollar more attractive to global investors, which resulted in capital inflows into USD assets like treasuries. This strengthened the dollar significantly. But what does that do to oil? Remember, a stronger dollar makes oil more expensive in local currencies for non US buyers. As prices became less affordable globally, demand weakened and oil started falling. And next one on our list is fear of global growth slowdown. On top of the strong dollar, there were also growing fears of a global economic slowdown. Trade tensions between the US and China were escalating, which impacted sentiments and created uncertainty about future oil demand. Slower growth meant less industrial activity, lower transportation demand, and overall reduced consumption of oil. So we had a double whammy, a strong dollar pressuring global oil affordability, and weak macro sentiment reducing demand outlook. This created the perfect storm for crude oil prices to collapse while the dollar continued to rise. So, this movement in late 2018 stands out as a classic inverse correlation event, which is dollar up, oil down, and for textbook macroeconomic reasons. It's a great reference point when trying to understand how monetary policy, currency strength, and commodity prices interact on the global stage. Now, let's fast forward to what's happening right now in 2025. And this is where things gets really interesting. Because unlike the textbook inverse correlation we saw in 2018, today in 2025, both crude oil and the US dollar index are falling together. That's not something we see often. So the big question is, why is this happening? What does it mean for traders and investors? So let's unpack it. First, let's look at the dollar index. The US dollar is weakening because markets are now pricing in a potential pause and rate cuts from the Federal Reserves. Why? We know that recent US macroeconomic data is coming in softer than expected. There is a slowing GDP growth, weakening labor market indicators, and decline in consumer spending and credit activity, along with lower than expected inflation prints. All of this has led traders to believe that the Fed might pivot away from its previously hawkish stance. When rate hike expectations vanish, the yield on dollar denominated assets will drop, reducing global demand for the dollar. The US dollar index has experienced a notable decline, dropping over 3% in March 2025 itself. This downturn is largely attributed to market expectations that the Federal Reserve may pause or even cut interest rates in response to slowing economic indicators. So let's look into more data. Inflation trends. In February 2025, the annual inflation rate eased to 20.8%, down from 3%. In January, while core inflation decreased to 3.1% from 3.3%. These figures suggest a cooling inflation environment and which will increase the likelihood of rate cuts later in the year. All right, let's look at the economic growth now. The US economy contracted by 0.3% in Q1 2025, primarily due to the businesses front loading imports ahead of tariff hikes. Despite this contraction, core indicators such as consumer spending and employment remain relatively stable. Next one is Federal Reserve actions. In December 2024, the Federal Reserve cut the federal funds rate by 0.25%, bringing it to a range of 4.25% to 4.5%. The Fed signaled a slower pace of rate cuts in 2025, projecting only 2 rate cuts instead of the previously anticipated 4. These factors collectively contribute to a weaker dollar, as lower interest rates reduce the yield on dollar denominated assets, making them less attractive to investors. As a result, dollar index is trending downward. But remember, a falling dollar usually gives oil prices a boost. So why is oil dropping too? And here is the twist. Crude oil isn't falling because of dollar strength. This time, the pressure is coming from the demand side. Several major global factors are weighing on crude prices. And the first one is weak demand from China and Europe. China, the world's second largest oil consumer, is dealing with an uneven post-COVID recovery. Industrial output is sluggish, real estate continues to struggle, and same with Europe. Europe is battling a mix of slow growth, energy transition cost, and geopolitical overhang from Russia-Ukraine crisis. Both regions are demand engines for crude, and both are showing signs of slowdown. Next one is rising US crude inventories. And yes, according to the latest EIA, which is Energy Information Administration report, US oil inventories are rising. In early February 2025, the US Energy Information Administration reported an unexpected increase in crude oil inventories by 8.7 million barrels, indicating an oversupplied market. US crude oil inventories rose by nearly 22 million barrels in the past 4 reporting weeks, one of the largest sustained builds since 2020. US production remains strong, with output from the Permian Basin hitting a record 5.9 billion barrels per day in March, even with rig counts falling slightly. So, when the supply is high, demand is weak, it's simple economics. Prices will fall. This signals supply is outpacing demand, especially with refinery utilization rates falling, and higher inventories is equivalent to lower urgency, which is equivalent to downward pressure on prices. All right. Next one is weak manufacturing and weak global trade. Let's dig into some data. Global PMI, which is Purchasing Managers Index, readings have come in weak. That means fewer factories are consuming energy. Global trade volumes have also dipped, reducing transportation fuel demand. China's March 2025 manufacturing PMI came in at just 49.2, still in contraction territory. Eurozone industrial production fell by 1.6% year on year in quarter one, with Germany and Italy showing sharp declines in energy intensive sectors. In the US, refined product demand is trending lower, and freight traffic, especially diesel usage by trucking firms, has dropped by 4.5% year over year, according to American Trucking Association. And yes, and the next one for a change is a good reason, and which is ceasefire talks between Middle East territories. A potential ceasefire in a major oil producing conflict zone such as Yemen, Libya, or tensions around Iran has led to more stable and increased oil output. Oil markets often price in geopolitical fear, but in 2025, those risks seem to be easing. There are active ceasefire negotiations underway in Yemen. Libya's production has returned to over 1.2 million barrels per day after recent disruptions, and Iranian oil exports are reportedly increasing quietly, reaching over 1.5 million barrels per day, despite sanctions. These developments reduce the fear premium that usually keeps oil elevated, leading to more downside pressure. So, less geopolitical premium is equivalent to lower speculative buying, is equivalent to weaker prices. So, bottom line is that it is a rare decoupling. So, even though the dollar index is falling, which usually boosts oil prices, but this time crude is responding more to demand side weaknesses than to dollar tailwinds. This is a rare decoupling of the unusual inverse pattern, and it reminds us no single correlation in the market is sacred. Context is the king. Now, let's dive into main topic, which is what should traders and investors do? How should you interpret and respond to this rare situation where both crude oil and the US dollar index are dropping at the same time? Let's break it down with clear practical takeaways for both traders and investors. All right. First and foremost, don't blindly assume that crude oil and the dollar index will always move in opposite directions. That relationship holds most of the time, but context matters more than correlation. In today's case, both are falling not because they are linked, but because of a broader global slowdown, soft demand, and easing monetary expectations. When both crude and dollar index are falling, it often points to a macro slowdown where industrial demand is shrinking, deflationary pressures with weakening pricing power across sectors, risk of sentiment where the investors retreat from commodities and high risk currencies alike. All right. So let's focus on what should traders do. I want to cover both, but let's, dive into the traders first. So if you are an active trader in oil or related commodities, watch key support zones. Like for Brent crude, keep an eye on $80, which is a psychological and technical level. For WTI crude, support is near $75, which is tested multiple times historically. A breakdown below these zones without strong demand triggers could mean deeper downside. Avoid aggressive long positions unless there is a reversal pattern like a double bottom, bullish, engulfing candle. If you see on the charts, go for the long. Or wait until a strong macro or geopolitical catalyst to emerge. For instance, OPEC production cut. Instead, look for short-term short setups or stay on the sidelines until you get the clarity. All right, we have covered the traders. Now let's focus on what should investors do. If you are a long-term investor, here is how to think. Reassess exposure to the energy sector. If you're holding oil producers, oil field services, or commodity ETFs, consider trimming exposure if global demand looks weak. Companies with high operating leverage to oil prices might underperform in a prolonged downturn. Look at the beneficiaries of cheaper oil. Airlines, because of lower jet fuel cost. Cement and logistic companies, which are diesel heavily based. Chemical and paint industries, because for them oil is a raw material. So lower oil can be a tailwind for certain sectors. So shift focus toward demand sensitive and oil consuming industries. So if you're thinking that we are done, we are not. We have seen the past and current, but you need to know what to watch ahead. The trend is still developing, so data is your friend. So keep a close watch on US inflation releases. A dovish print could reinforce the weak dollar narrative. Watch on Fed minutes and FOMC meetings for any change to rate guidance. Watch on EIA oil inventory reports because we know that large bills is equal to bearish. Watch China PMI and export data because we know a demand revival there could stabilize oil. And most importantly, watch for geopolitical updates. Any escalation or OPEC intervention could swing prices. So, in the markets like this, being data driven and macro aware is your biggest edge. Forget textbook patterns and try to read the narrative behind the moves. Now, let's talk about the major near term catalyst, the OPEC meeting in May. This could be a decisive movement for crude oil prices, especially in light of the recent weakness, and here is why. Okay, what's expected from the meeting? Let's dive more into it. OPEC Plus, which is the coalition of major oil producing nations led by Saudi Arabia and Russia, has been managing supply cuts to stabilize oil prices since the COVID shock. As of now, markets are speculating two possible outcomes from the May meeting: status quo, which is keep existing voluntary production cuts in place, or deeper cuts. If prices fall further or demand data worsens, they may extend or deepen supply cuts to support the market. Now, you must be wondering how this could impact crude oil future. All right, let's understand that. If OPEC announces deeper cuts, it could be seen as a strong bullish signal. Oil prices may bounce quickly from current support zones, and futures may see a short covering rally and fresh buying. But however, if they keep production unchanged or signal increased output, it may trigger more downside, especially if demand remains weak. And traders could see this as OPEC's unwillingness to defend current price levels, and sentiment might deteriorate further. So, what to watch during the meeting? I would say watch language around demand outlook. So, are they worried about China, Europe, or the US? Or notice Saudi Arabia's tone historically. Saudi Arabia has led aggressive cuts when prices fall too fast. Look out for any surprise move, like voluntary cuts by individual members, which often come as last minute headlines. So, to sum it all up, yes, both crude oil and the dollar index are falling right now, but it's not a random coincidence. This is not your textbook inverse correlation. The current oil drop is not because the dollar is strong, but because of the something deeper and more fundamental, which is growing fear around global demand. From China's sluggish factory output to Europe's weak exports to the US showing early signs of economic slowdown, all of it is feeding into oil traders' minds, saying, maybe we don't need as much oil going forward. And that's a bigger red flag than just a rising or falling dollar. Now, I want to hear from you. Did this divergence between oil and dollar index surprise you? Have you adjusted your trades or portfolio accordingly? So please don't forget to comment below. I read every single one. And if this breakdown helped clarify what's happening in the market, smash that like button, hit subscribe, and click the bell icon because every week I bring you clear, no hype market decoding just like this. And thank you for watching, and I'll see you in the next one.